Hello guys! Many people today believe that artificial intelligence could threaten SaaS companies. But after listening to the latest earnings calls from Adobe, Intuit and Salesforce, I actually came to a different conclusion. And the conclusion might actually surprise you. So, in today's video, we are going to talk about three companies from the SaaS sector: Adobe, Intuit, and Salesforce. Recently, these companies reported their latest quarterly results. So, I want to briefly go through them one by one, look at what results they delivered, what kind of guidance they gave for the next quarters, and also some important things like share buybacks. And at the end of this video, I'll share my personal conclusion about these companies and how I see them as long-term investments. But before we continue, I want to ask you for a small favor. If you enjoy this kind of content and you follow my journey, please subscribe to the channel, leave a like or write a comment. It really helps the channel to grow, and honestly, it motivates me a lot to keep making the next videos. Alright, let's start with Adobe. Adobe recently reported strong quarterly results. Revenue reached a record $6.4 billion, which represents roughly 11% growth year over year. And what's also important, this was actually a record quarterly revenue for the company. Earnings per share came in at about $6.06, beating expectations. The company also provided guidance for the next quarter. Adobe expects revenue in the range of about $6.43 to $6.48 billion and earnings around $5.80 per share, which means the company continues to guide for steady growth. However, despite these strong numbers, the stock actually dropped after the earnings report. And one of the reasons is that the long-time CEO announced that he plans to step down after about 18 years being with the company. During that time, Adobe completely transformed its business into a subscription-based SaaS model, and the company grew substantially. So naturally, the market reacted with some uncertainty because investors strongly associate him with the success of the company. But in my opinion, the business itself continues to perform very well, and we see record low PE ratio. Revenue keeps growing at double-digit rates. Adobe continues to integrate AI features across its products, and the company also continues to return capital to shareholders through share buybacks. According to the latest report, Adobe plans to repurchase roughly 9 million shares in the upcoming period as part of its buyback program. So personally, I see the recent decline in the stock more as a potential opportunity rather than a sign that the business is weakening. Now let's move to Intuit. Intuit is the company behind the products like QuickBooks, TurboTax and Credit Karma. And over the past few years, the company has shown very strong growth. For fiscal 2025, revenue reached about $18.8 billion, which represents roughly 16% growth year over year. And management expects this growth to continue. For fiscal 2026, Intuit guided revenue between about $21 and $21.2 billion, which represents around 12 to 13% growth. Operating income is expected to grow even faster, roughly around 17 to 19%. And another important point for investors is the capital return. Intuit also runs an active share repurchase program and continues to return billions of dollars to shareholders through buybacks. So again, we see a SaaS company that continues to grow while also returning capital to investors. And finally, let's talk about Salesforce. Salesforce is one of the largest SaaS companies in the world and the global leader in CRM software. The company recently reported annual revenue about $41 billion, with around 10% growth year over year. Operating cash flow reached roughly $15 billion, which shows how profitable this business has become. But one of the most interesting things here is the capital allocation. Salesforce announced a massive share buyback program of up to $50 billion. And recently, the company even issued about $25 billion in debt to accelerate these buybacks and repurchase shares faster. That's very significant number, and it clearly shows the management believes the stock is very attractive at current levels. Now, let me share my main takeaway. There is a lot of discussion right now that artificial intelligence could disrupt SaaS companies. But a few days ago, I listened to the Adobe earnings webcast, and during the call, management mentioned several times that AI is actually a tailwind for the business. And you can actually see it for yourself. Right now, I'll show a short clip from the earnings call where one of the executives explains exactly this point.
As we execute on our strategic initiatives, we're pleased with the progress we're making against three growth drivers. First, new user acquisition is gaining momentum, and we are reaching more new users than ever before as measured through the growth of monthly active users. Notably, Creative Premium MAU crossed 80 million, growing 50% year over year, and includes web and mobile versions of Firefly, Express, Premiere, Photoshop, and Lightroom. Second, AI usage continues to grow quickly as measured through record levels of generative credit consumption. Third, our content automation solutions continue to see strong enterprise adoption as measured through record numbers of API calls. These metrics highlight that we're executing against our strategy to empower individuals and businesses to create content in new ways in the era of AI.
So, instead of being threatened by AI, these companies are actively integrating it into their products and using it to make their platforms even more powerful. That's why I personally wouldn't rush to put AI and SaaS on opposite sides. These companies are adapting, evolving, and in many cases, AI is actually accelerating their growth. That's one of the reasons why I continue to follow these companies very closely. So that's my overview of Adobe, Intuit, and Salesforce and what they recently reported. Thank you for watching this video, and I'll see you in the next one.